All right, what's up? Albert, how are you doing today, sir?
Man, I am doing very well. I am just really digging this weather change from last week. So, the cooler weather, just the nicer weather outside is always motivation for me to go look at properties.
Yes, it was a nice day outside this morning. I hit the trails late last night and I hit them again this morning, so it was nice.
Yeah, it's good weather. It's good. It's a good reason to be outside. If you're in real estate and you're investing, it's a good opportunity to go walk some properties and not sweat your butt off. So,
Yeah, exactly. Some of that stank is starting to die down a little bit, so it's
yeah.
not it's not so bad.
Mm.
So, first Monday, every Monday of the month, every first Monday of the month, we do a deep dive on some deals. And Albert and I have been talking about the incredible power of appreciation and how appreciation really impacts what the values on real estate investors. I'm going to make sure I'm live. So we're going to be looking at some data. I'm going to show you some back end stuff today, and then hopefully we'll have some people on the meeting that will make some requests. So we're taking requests on the show today. This one goes out to the one you love, someone special. Give me a zip code, a submarket. Give me a county. Even give me a school zone. A school district that a property is zoned to. Our goal for today is to get a little bit of better understanding of appreciation and where those trends are going. Because the one thing I know, there's so many factors in real estate that I cannot promise you. I don't have a crystal ball. People ask me all the time, what do you think is going to happen in the next 6 or 12 months? I would not be a man of wisdom if I started spouting out ideas, but I can look at the trends. And based on the trends, 100% of the time in history, property values go up at some point. They go up way up more often than they go down. And so we're going to look at that today. So appreciation in a world where investors are looking at cash on cash return.
Yeah, I think appreciation does get overlooked, and I don't think it should be overlooked, but at least from my perspective, it shouldn't necessarily be the primary decision point for you when you're
Right.
looking into investing in real estate. And some people are kind of on both ends of that spectrum. They either don't account for it at all, which okay, or they account for it too much to try to make the deal a good deal. And
Right.
that's dangerous. And then that's more dangerous than not accounting for it all. But I like that we're going to deep dive into some numbers today. You're going to show us some things on your screen. So I'm like really looking forward to it. I'm a student today, so I'm ready to go.
So, with the power of technology, I'm going to share my screen with you today. And so, first thing I want to look at is I want to look at houses, single family homes. I think it always starts with that. We're going to go back in time, and there's multiple resources that you can use to find some of this data. But what we're going to look at is the average sales price, and we're going to go back 10 years. So
Mm.
we're going to start with 10 years. Now, I know some people are saying 10 years really isn't enough. Yes and no. It's enough for our exercise today, and it's enough to get micro into what we're going to be jumping into. So there's a different metric for sales for average sales price as there is for median. So we're as for median. Mean is the same as average. So we're going to group this by month. And let me show you what I'm looking at. So this may be kind of confusing. So I'm going to break it down. So as of September, even October, we are in the month of November. So
Mm.
these numbers, just because the month of October is over, it doesn't mean these numbers won't change a little bit. Sometimes some of that data gets inputted retroactively. And so you'll see fluctuations in the last 3 to 4 or 5 months. However, in January of 2025, the average sales price of a single family home,
In 2015, yeah.
yeah, it was $264,000. Okay. Now, I'm gonna see. I'm gonna app open. So I'm using ChatGPT Atlas right now, and I'm gonna do all this math using AI, and I'm gonna say calculate average appreciation over 10 years, and we'll get this guy rocking and rolling. So what it's looking at, it'll just tell you. So 2015 to 25, the average property value. This is for single family homes only. Agents, make sure you are double checking your criteria that it's inputted right. Because if you include everything, it's going to include land and condos will throw this way off. So average appreciation is 4.4% a year. And now you may be saying to yourself, that doesn't seem like a lot. That is a very consistent number. What does
Hmm.
this mean for you? If you put 25% down on a property, this is where this becomes very, very powerful. So if you buy a property for $1 million, and I'll have ChatGPT confirm this for us, but if you put 25% down on $1 million, what is your down payment?
$250,000.
That's your investment. So your investment's not $1 million, it's $250. So if a $1 million property is cash flow zero, what's the IRI with a 25% down payment? So the easiest way to think about this is 25% is the same as one fourth. So if you take four and multiply it by the appreciation, that's your return. So it should be about 17 or 18% return. I think that's a pretty good return on your investment. So $1 million, 25% down, the cash flow, zero. And it's assuming 30 years, 6.5%, 4%, 4.4% annual appreciation.
Hmm.
So if
So
a 1 million, go ahead,
13.8% per year.
13.8%,
Per
25% down with typical financing. So this one's going really deep. It's taken into loan, equity. Yeah, that's like more than tripling your money in 10 years. That's a huge return. So that's a minimum of
Oh
12,
wow. Yeah.
12%. So that 4.5% is really three times as much right there.
Hmm.
So that IRR, so if your cash flowing is only like, say your cash flowing is, you want to be around 8 to 10% after improvements are done. You're just going to add that, and now you're in the 20s.
Hmm.
So that eternal rate of return, it's way simpler. So you may be on the call, or you may be watching this video. You may have a property in, let's say, pick a market.
Hmm. Does it have to be a small market or does it? I mean, Houston's too big, right?
Yeah, so right here, what we're looking at is all of the greater Houston market right here. So say you want to look at, we can go to Austin, for instance. So 13.8% on a 25% down payment. And I've got Abor, that's the city of Austin, San Antonio, Sabor, North Texas. We just got North Texas on our on our system. We'll let it spin. So maybe some of those properties that you have, Albert, is maybe doing a lot better than you think, even in the market. So here's Austin, 300 to 594. What about in Austin, Texas? So
Oh
it's
yeah, that's good.
yeah. So according to long-term analysis, rose from 218 in 2000. See the screen. Are on a cash flow zero with 25% down. Maybe it's thinking. So it's coming up with 15.6%
Wow.
IRR. And again, there's no income. We're producing no income on this. This is just on the exit that you're
On the
making this.
appreciation, right? If you
Yeah.
hold it for 10 years.
So let's go back home. We'll come back to Houston. Um, let's break this down by county. So we'll start with Harris. And then before we end the call, I'll have ChatGPT do a summary of all the different areas and just basic cash flow zero, 25% down. We're not going to change any variables. We're just going to start looking at different micro areas. Now, I do want to get into multifamily today. So this is Harris County only.
Austin, I have a question.
Yes, sir.
So, so we're thinking that it's only figuring appreciation and no cash flow. Is that what you said?
Yeah, this is no cash flow. So you're going to add
So
your
what is
cash.
it? So is it assuming you think that like you're not making cash flow yet, or that you're taking it, that you're putting it back into that, or putting more into your equity? Like, do you know what it's assuming you're doing with the cash, or just assuming that you're not making any?
Yeah, for
Does
this
that make
exercise,
sense?
yeah, for this exercise, it's assuming that there's no cash flow. So it's basically a calculation at cash flow zero. So
Is zero okay? So
if there is cash flow, you would just add it to the IRR. So what we're just trying to do is show what that return on just what the appreciation is. Does that
So
make
that other
sense?
one was yeah. So the other one was 15.8 IRR appreciation only.
That's just appreciation. If
Okay. So if you then if you had cash flow, obviously you would add that into your return.
correct.
Yeah. Yeah.
And anything above 8 is worth looking at. 10%, is very possible after repairs. But just for just a rule of thumb, like if you can get that thing to cash flow 10% after repairs, that's a great deal.
Hmm.
And then you would add it. So here's Harris County going back 10 years. So in 2015, Harris County, the average price was 287. I think it's just rounding it off, and then 449 is the average price, sales price in October. So buying something at $1 million, 25% down, appreciation, 4.6 appreciation is what it's calculating right there. So Harris County is probably a little bit better than Galveston, but the Houston, like HAR, that includes all the adjacent counties to Harris County, Brazoria, Montgomery, etc. So 4.6 appreciation in Harris County. So a little bit better than the rest of Houston.
That's good to know. So,
Yeah.
yeah, that's really good to know. That's really good data for real estate investors to, plug those numbers into your underwriting, right? Especially if you can get into properties with, if you're trying to do a BRRRR, right, which we
Hmm.
talked about, and you're able to get a lot of your cash out of those deals where maybe you're invested for less than 10%,
Yeah.
then your return, your IRR is going to be much higher, right, over that 10-year period
Yeah.
because you have less invested. Maybe you only have 10% of that sales of that after repair value, right? Because that's what it's going to appraise at whenever you're done and you do your refinance.
Yeah.
Yeah.
Yep. Absolutely.
That's powerful. Yeah.
And
So
it,
do you know then, like we were talking, I believe it was last week about changing what you put down. So how does it affect it then if, like some people want to buy properties for all cash. So is it
yeah.
advantageous to to put to pay for it in cash?
No.
No.
And I'll show you. That's a great question.
Yeah.
Or
And I
or is
and
there so I guess what I'm asking is where's the sweet spot? So like you went 25 and we're assuming that it's not a good idea to do 100, but is 15 better than
I,
25? Or
I,
you know,
Austin's going to go through some data, but what I've always like learned, at least how we you purchase properties, like our goal is to put as little down as possible, right? Use as little of our money as possible, whether it's our money or our lender, or our private lenders use as little of their money as possible at the end, like when we refinance that property. You know, we're going to fix it up and then we're going to refinance it. It's going to be worth a lot more than what we purchased it at. And so the goal is to have as little in there. It's also for us, at least the smaller investors, right? We'd like to cash flow. We'd like to get that first level of that return on an investment. We don't necessarily count on appreciation, but we don't discount it either,
mhm.
right? So to kind of like from my perspective, Austin can answer this here in a sec. From my perspective, Richard, I'm trying to put as little down as possible that's not going to have a big impact on my rate, where I can still cash flow something at the end of the day. And then I'm going to let the market take its course, right? It's going to be a long-term hold. If the market goes down in the next 5 years, fine. I don't care. It's probably going to rebound the next 5 years after that or the
Right.
next 10 years after that.
Yeah.
well
Uh,
going off of that, Alberto, what do you do with your cash flow then? Do you put it back into it? You put it on a additional property?
Yeah, the cash flow goes into like it goes into whether it's cash flow or the and also the cash that we get out from the cash out refinance. I know I can probably earn a much larger return on that investment if I'm
mhm.
putting that into a new investment.
Right.
So then I'm taking that cash flow and building that next, whether it's a down payment or whatever it might be to get into the next property.
Mhm.
Yeah, so you just sideline it until you get 25% down for another property.
Right. If
Yeah.
if that if that is your strategy, if
Okay.
your strategy is putting 25% down, yes.
Yeah, and that's another
Got
like ladder method. If you don't want to exit out of your properties, you just build up that equity, and then once you have and it you could do a combination of saving the money and the cash flow as cash flow. Like if you're gonna do, from what I understand, if you're gonna do a self-directed IRA, for instance, you got to keep that money in that account anyways. So
Hmm.
between saving money, the cash flow, saving that net profit, and building equity into the property, you can move into your next property quicker. So I love your question, Richard. I'm gonna pull up a property that I've been looking at. This one, uh, this is a property. It's listed on Krexy, 27 units. So when we're looking at a deal, and this is a really good tool for evaluating. So right now for commercial lending, you can expect to see if you go through a bank about 7.25% interest rate.
Hmm.
They're asking $1.95 million. And we believe that their net operating income is 167. That's their profit. That's after they pay their insurance. That's after they pay their taxes. That's after everything. It's all of their rental income minus vacancies, minus expenses.
Not counting like debt service though,
This
correct?
had, yeah, this is completely, so debt service is not being applied here yet. So the seller's debt service is completely irrelevant to the buyer.
All right.
Now, down payment, we'll put 25% down. Some banks will require more, and we're going to play with these numbers, and I'll show you. But there's not a lot of banks that are going to, on these commercial deals, they're going to give more than 25 years on the amortization. So the loan amount being 1.462. This is the debt service. So this DSCR is the first number that the banks are going to look at, that 1.32. Right now, there's not a lot of banks that are going to look at. So what DSCR is, this is the ratio. It's a debt service coverage ratio. That's the ratio. That's basically how much money is left over after the mortgage is being paid.
Right.
So if the mortgage is $1, there's 32 cents left over. And so what the banks aren't touching properties right now that don't at least start at a 1.25 DSCR. And a lot of these deals, they're not hitting this number. Most are below one. A lot of them are below zero. Anything that's below one. Most of them are below 1.25. A lot of them are below one. Anything that's below one is bleeding money. So there's negative cash flow. That means that the property owner is having to pay out of his pocket to cover the mortgage. So cap rate, this is another good factor because it shows if you, and this is to answer your question, the difference between ROI and cap rate. What your cap rate is, it's a metric that has nothing to do with the debt service. Your cap rate is basically if you bought this thing cash, you would have an 8.6% return because the net operating income is 8.6% of the purchase price, 1.95. The ROI is 8.38%. That is, if you think of debt, like your down payment and then the property and then your debt service, this is how much money's left after paying the debt. So the ROI is your return on your 487,500. Make sense so far? So your question is, does it make sense to buy cash? Like that's your reference point, is your cap rate. If you were to pay 100% down, buy it all cash, that would be your return. So right now with this metrics, the return is a little bit lower. Now your investment's a lot smaller, but your return is a little bit lower. So you kind of want to get this to justify financing. You want to get it above that. So what can we do without changing the purchase price? If I raise this down payment to 30%, do you think that return on investment is going to go up or do you think it's going to go down? Any guesses?
I think your ROI is going to go down.
Down.
Okay, so if I raise my down payment from 25 to 30, it's going to go from 8.38. It actually went up. But why would somebody do that? Well, the DSCR went up too. There's more money. The bigger the down payment, the more money is left.
Hmm.
Now, this is not another really like deep, complicated calculation is, how much are you actually making over time when you factor in your interest versus principal? Because obviously, Richard, yeah, if you pay 100% down, you're actually paying less over time if you end up holding on to that property. So by decreasing,
Okay.
to 20%, like the banks aren't even going to touch that because it doesn't hit that 1.25 number.
I got you.
So what else can we do to get that ROI up? if I go from 25 down to 20% down, the ROI starts going down.
So at what point does that ROI start going down, you said?
Yeah, it goes down as the down payment goes down, the ROI goes down.
Oh, I got you. Because your debt service, your ratio goes down as well, right? Because your
Hmm.
cash flow is going to be less because
Yeah.
your mortgage, your debt service is going to be higher.
Hmm.
You have more interest over time as well, I think,
Yeah.
right? And so, okay, those things are going into the calculation for this ROI if you put
Yeah.
less down.
That's why I think it's good to play with these numbers.
Gotcha.
Like like term. Here's if you amortize a 25-year AM is going to be more expensive than a 20-year AM in the long run, but it's going to be cheaper in the short run.
Right. Your payment, monthly payment's going to be lower, but over time you're going to pay more in interest,
Right. Exactly.
right? Yeah, I
So if I
got you.
take that 25-year and I put a 20-year, my
Then your
ROI
ROI goes way up.
it goes down.
Oh, it goes down.
Yeah.
Really?
Yeah, there's
Because your payment, okay, I got you. Because that's almost has a similar impact as putting less money down also.
yes. Yeah, it
Because
does.
because your debt service is going up,
But
right?
yeah, but
Okay,
if
I
you
got you.
that we're not going to do this calculation, but if you say hypothetically, if I hold this property for the term those numbers will look way different over a 25-year.
Okay. What
Be,
period are we looking at this right now?
right now, we're just looking like on a 1 year basis, on an annual basis.
Got it. Okay. I got
So
you.
yeah, there's two adverse metrics, and I know this is kind of getting kind of deep in the water, but there's two adverse metrics: the amortization versus the down payment. And I'll probably just leave it right there. But obviously, if you can negotiate that interest rate somehow, and usually the best way to negotiate it, that interest rate is typically going to get your ROI way. That's going to have a big impact on the ROI and the cap rate. Is that interest rate? Because when
A
we're at,
lower a lower
yeah,
interest rate.
if we're at 7.25, my ROI is below my cap rate. At 7%, I'm still above it, but at 6.75, I mean, that makes a pretty big difference. Like that's really good. And so that's the reason in the multifamily space. And notice we haven't touched the purchase price at all. And everyone buying a property, you should have a plan on increasing the NOI somehow. But in the multifamily space, all the leads we're getting right now are asking about owner financing.
Mm,
Because if I can get this to a six, if I can get the owner to do a six, look how like the purchase price is really this interest rate is a big factor in this because I'm at 11.21. So if my return on my appreciation is 12 to 16%,
hmm.
because remember it's appreciating at 4.4% with 25% down. My internal rate of return, and that's not being calculated here, but my internal rate of return is this 11% plus the 12%. It's a 23% internal rate of return. Richard, did that answer your question?
Yes.
Okay. So, any thoughts, Albert, before I move to the next one?
No, that's a definite deep dive. I think you
Eh,
had me at more down payment, lower IR, no,
I'm glad I got your gear
higher
spinning.
ROI. Yeah,
Yeah.
now we're good. I'm good.
So the higher the down payment,
The higher your ROI.
but we'll have to figure this part out because with the 6% interest, it's not, for some reason, when you go to 30, look at my ROI.
You're not sharing your screen, by the way. I don't know if you meant to.
Oh, I'm not? This whole time, huh?
Correct.
Can you see my screen now?
No.
Richard, can you see my screen? I am screen sharing.
Yeah, I see it.
Oh,
Oh,
that's all you,
wow.
brother.
That's all me then. Huh. Interesting.
You
Okay.
see,
Well,
you got it?
no, but then fine. Don't worry about me.
Okay. Yeah, it goes down as you increase the down payment, the ROI goes down.
There we go. I see your screen.
Yeah. So you see as I increase it.
Yeah.
I don't know. So this is here here's what I do for my buyers is when they're looking at a property, I'll run this evaluation for them. And I could do this for anybody. Anytime you want me to run an evaluation on a property, I will use this tool and play with the numbers. And the last thing we're going to look at is the purchase price because obviously lower purchase price is better for everything else, better numbers. So, um, let's let's switch asset types right now. So, I'm going to look now at multifamilies and I'm going to look at if it lets me. I'm going to look at if it shows me the units. So we'll do just average sales price. And we're going to use all counties, HAR. And unit count, we're going to do 2 to 4 units. So just small multifamilies. Okay. So do you think the appreciation
Oh,
on multifamilies is stronger or weaker than single family?
stronger.
So 2 to 4 units, calculate appreciation and IRR at cash flow 0. This is probably one of the most important episodes we've ever done. It's very deep, and I think it'd be worth watching again. But we know single family homes is somewhere in that 4.5 range,
Right.
4.4 to 4.8.
Yep.
This is just for 2 to 4 units, going from January 2015 to October 2025.
Uh, is it reading the right numbers though? Because it used 450 and 240 on the average price.
Good call.
Because what did it come back with anyway? 15? Oh, 6%, something like
It's
that.
saying 6.5%.
Okay, so it is saying a little bit higher. Okay. I'm just wondering what numbers it actually did it use the numbers on the screen? Because that says 152, right?
Yeah, it's averaging. It's taking an average of because if you go back to 2015, this is just 2 to 4 family units.
Mm,
There was some outliers in
I see.
September and October.
I got you.
So some of this data is going to be
Okay, so it's taking an average. I got you. Okay.
yeah.
Okay. Okay. That makes sense.
hmm So if you buy $1 million, IRR with 25% down, you buy a property with $1 million, your down payment's 250, the loan's 750, 6.3%. And I can tell you on top of that appreciation that these multifamilies do tend to cash flow a little bit better than single families. So your equity after 10 years is 1.84 million. So the net gain, that's an IRR of 16.8. on your, those are only for 2 to 4 units, 2 to 4 unit um, multifamilies in Houston. 16.8
Wow.
IRR with
Yeah.
25% down. 10-year appreciation is at 6.3%. It's almost 2 points higher than single family.
Mm-hmm.
Okay, so I want to look at one more thing because I'm going to look. So once you get to five,
Five
or
plus?
yeah,
Or okay. 5 to 16? Okay.
yeah, this could get a little bit weird. But once you get to five, those are commercial deals, and so there's a lot of missing.
Oh, interesting.
Yeah, this is going to be.
I was like, man, your screen didn't load all the way, buddy.
Yeah, so it probably didn't even have records from 2017.
Hmm. Not in HAR at least,
See
right?
that? Yeah.
I mean, the records might exist somewhere.
So we can spend more time on this, I'll talk more. I do talk more about multifamily and appreciation trends, and once you start getting into more, because obviously there's a lot more houses that trade in any given month, and we have a lot more data with single family homes. So with multifamily homes, the best way to really track those trends is just to go broader, go like
Yeah.
all over Texas. But according to this, it's about the same, 15.2%.
Mm-hmm.
But this data
5.1%.
is all over the place, so
Yeah.
I probably wouldn't trust it that much. But the purpose of that is to show how powerful that metric is, and I think a lot of people fail to really take that into consideration because you know there's a lot of people making a lot of money, and we've said this before. Uh, it may not be cash flowing. But some of the best investments, some
Mm-hmm.
of the best real estate investments don't cash flow for a couple of years. You know, so Albert, what any thoughts, or what are any questions that you have, or if anybody else has
I
questions?
told you at the beginning, like before we started this call, I told you I was gonna learn from you today, and I really like how you used AI to really run the numbers for you, getting the numbers, getting the data. Like I just really didn't realize, like, full transparency, how powerful that appreciation number could be.
Mm-hmm.
I mean, whenever I'm kind of looking at properties, right, I'm primarily on the single family side. I'm looking at like 3 to 4%, on average,
Mm-hmm.
Galveston County, Harris County, you know, and I'm not really extrapolating it like out 10 years,
Yeah.
or longer. I'm just kind of looking for the next 3 to 5 years. Okay, cool, right? Looks cool. Not really having that make too much of my decision, but man, it's like some deals, you're right, that I'm thinking may not be great deals. If the goal is always to hold on to these for the long term,
Mm-hmm.
right? They can become better deals
Yeah.
over that period of time, you know. Um, like I tell all of our students too, is some of them ask like, well, why did you accumulate so many properties, right? I mean, we have 11 now
Mm-hmm.
in 5 years. And what I told them was, I look at each one of these little properties as a little piggy bank or bank
Yeah.
account, that grows over time, right? Obviously, I'm getting some cash flow from them. The debt pay down
Mm-hmm.
is being paid by someone else. I'm getting the tax benefits from that, and I'm letting the natural market kind of run its course.
Right.
You know, 10 years from now, I'll be 60,
Mm-hmm.
right? 10 years after that, I'll be 70, and that'll be like, maybe that'll probably be the retirement age that the government's raised people up to, maybe past that by that time, right? But between the next 10 and 15 years, I'm probably going to want to be tapping into this real estate, right?
Mm-hmm.
To fund our lifestyle.
Yeah.
And if we now have properties that have appreciated that much, compounding every single year,
Yep.
right? Then you've got 10, 15 properties. you can start cashing out on these things once every couple years while you're still accumulating one
Yeah.
every couple years as well. Yeah, I love it, man. There's a lot of power in that. I'm really glad that we did this. I was just really a student today. It was good.
I think it's an interesting data dive. I think the challenge, the reason why a lot of people don't keep up with that, because it is kind of it's difficult to interpret and it's difficult to calculate on your own. And with the power of ChatGPT, it makes it a lot easier to organize that data. So it does take a lot of work to really put that picture
Yeah,
together.
yeah.
And just because you buy, a single family home in the inner loop, there are a lot more other factors when you're buying that are going to affect that appreciation. Because if we had more time, we could break it down by school zone, for
Hmm.
instance. That's going to have an impact on it. This, which school it's zoned to, and so you'd have to isolate it. Or you may say, um, here's a good question: what is the average annual appreciation of a three-bedroom in this zip code compared to a four-bedroom in the same zip code?
Mm.
And so you're not looking at the average sales price, you're looking at appreciation. Well, that's a pretty complex calculation because you got to do a chart for both of them and then compare those.
And then run the calculation.
Yeah, you have to, exactly, exactly. And then with apartments, it's kind of the same thing because, you know, we don't even have enough data, historical data to say, well, the fourplexes, if multiplexes appreciate greater than single families, then a fourplex, you may assume that a fourplex would appreciate more than a twoplex, and the eightplex may, but we don't even have the data for that. Like we don't even have enough data
Yeah,
to put that to answer that question. I think it's true. I think an eightplex will appreciate more faster than a duplex, but I don't have the data to back that up. So it's just a prediction. But
yeah.
obviously, the multifamilies consistently do appreciate more than single families. That
Mhm.
that we've concluded.
Mhm. And it's just so much to learn too, like asking the right questions when you're looking at this data, having the right people on your team, like a good agent like you that I can go to and say, hey, can you help me run these numbers? What does this look like? Working together and kind of coming up with good questions because even knowing what's the difference between a three-bedroom and four-bedroom
Yeah,
appreciation, right? Because right now we were just looking at all single family,
yeah,
across the board when we looked at those numbers. When you now that you can even get a little bit more kind of specialized in what you're looking at, say, okay, cool, I want three beds.
yeah.
Yeah.
Let's just look it up. This uh, says no listings were generated. Oh, because I put
Oh,
unit count down here. So yeah, let's look at that. What's
it's a
look?
three-bedroom properties, right?
Yeah, on three-bedroom properties, and now it's calculating 195 to three.
4.96,
Okay, so
about 5%. Yeah,
that's actually a little bit higher.
that's higher than the overall number, right? So let's go down to four.
I would not have expected that. Okay, we'll do this real quick and then we'll call it. The thing about Atlas, I think you have to, when you say look at the screen, you actually have to show it like it's watching my screen. But if I have it below the screen, it's not going to see the number.
Interesting. Four, lower.
Oh, so who would have expected that?
Hmm.
That, like, I never would have expected that. So are three bedroom houses a better investment? These are five. I think I put five on here.
Yeah, five plus. Yeah. Uh-uh.
Try again. 554 to 761.
3.2.
Wow. Huh. That was a surprise.
So three-bedroom houses are more valuable over time, right? I mean, is that kind of what it's saying?
That's what it's saying. It appreciates faster.
Yeah. Interesting.
I'll have to, yeah, that's a mystery to me. Don't ask me why that is. I never would have expected that.
Huh.
But it's interesting what you discover when you just dig into it and start asking questions.
When you explore and discover.
Explore and discover. We're going to end it on that note.
Yeah.
Brother, have a good week. Thank you, everybody, for joining us. Don't forget to like and subscribe. Hit the notification bell. We are on Spotify. We are on Apple Podcasts. We are on YouTube. We are on Zoom. We are on Facebook. Where else do we need to be? Right?
We're everywhere, man.
All right.
Worldwide. Let's go.
All right. Let's get
All
it.
right.
Bye.
Have a good one.